Hi, welcome to the November 2019 edition of CUNA's Economic Update, our monthly video review of market developments and credit union operational trends, sponsored by the CUNA Finance Council. I'm CUNA economist Mike Schenk. Recent economic developments are in line with CUNA's expectations, as outlined in our most recent economic forecast. Economic growth slowed in the third quarter, and the 1.9% increase in GDP was just 1/10 of a point higher than our prediction. As we anticipated, the Federal Reserve lowered its federal funds interest rate target by 1/4 point. And today's just released October jobs report shows continued strength in labor markets, with 128,000 jobs added and an unemployment rate that remained near a 50-year low at 3.6%. As we've discussed in the past, healthy and generally improving economic conditions are obvious just about everywhere you look. But that's not to say there aren't significant challenges. In fact, challenges and dislocations aren't difficult to find. Consumers in the nation's inner cities and those in urban areas continue to reflect especially difficult circumstances, even though the economy as a whole seems to be performing well, and in spite of the fact that the economic expansion has entered its 11th year. As CUNA economist Samira Salem described in her economic update several months ago, we're in the process of building out a compelling narrative on the transformative power of cooperative finance in these challenged areas. Samira's discussion emphasized our preliminary work on credit union branching, which reveals that branch location matters, especially for non-wealthy consumers. Importantly, she noted that compared to for-profit banks, credit unions locate a higher percentage of their branches in lower income and modest means areas, while banks locate a higher percentage of their branches in higher income areas. Those findings hold for both urban and rural areas. Credit unions clearly are doing their part to reduce obstacles to financial inclusion across the country. We're continuing that work and are now looking at trends in branching over time, which we think will show that banks are closing branches in challenged areas while credit unions reflect a continued commitment. FDIC data shows that banks have closed over 11,000 branches since the Great Recession. And according to the NCRC, nearly 90 banking deserts have been created in the process. In today's economic update, I'd like to spend a few minutes focusing broadly on the challenges faced in the nation's rural areas and the presence and impact credit unions are having in small-town America. According to the Census Bureau, about 97% of the nation's land area lies within rural counties. Roughly 60 million people, almost 20% of the U.S. population, reside in these areas, and about 1% of the population lives on farms. By contrast, in 1900, 60% of the population lived in rural areas and 40% lived on farms. Nearly all the contemporary economic and demographic data we have suggests that the nation's rural areas continue to suffer from a steady decline and increasing despair. The 2018 edition of the USDA's annual Rural America at a Glance publication paints a picture of persistently weak employment gains, weak population growth, and disproportionately high poverty rates. Agricultural employment is changing and shrinking as corporate farms absorb family farms. Recent trade policy, and tariffs in particular, are having far-reaching negative effects. As manufacturing has become more automated, manufacturers have sought workers with more technical skills. To reduce costs, they move to be closer to transportation and communication infrastructure. This movement of these jobs toward urban cores, combined with global competition and automation, means that rural areas lost nearly 1/4 of their manufacturing jobs over the past 20 years alone, a trend that, not surprisingly, accelerated during the Great Recession. The number of good employment opportunities in rural areas is on a declining trend, and the evolution of jobs to those with lower incomes and lower benefits compels an increasing number of rural residents to migrate with the jobs to urban or suburban hubs. The result in many areas is a substantially smaller and older population that remains. Businesses and services decline in that context until they cease to operate. Government shrinks and ceases to provide services as the tax base declines. Not surprisingly, in this context, poverty rates, any way you cut them, are disproportionately high in rural areas. In the aggregate, according to USDA analysis, roughly 16% of those who reside in rural areas now live in poverty. Today, the nation's rural population is almost 30% more likely than those living in metro areas to be poor. Non-metro poverty rates are higher than metro poverty rates across each broad geographic area examined by the USDA, with the differences especially pronounced in the South, where nearly 21% of the population is poor in rural areas, and that's almost 6 percentage points higher than the figures seen in southern urban areas. Compared to metro areas, non-metro poverty rates are also higher across racial and ethnic groups, across all family types, and across all age groups. In many of the nation's small towns, the presence of an active, engaged financial institution is critical in helping to slow and, more importantly, offset these trends. Infusions of capital help to revitalize businesses, and loans to assist young people in advancing their education and improve their skills help to stem the tide of rural manufacturing flight. Credit unions play a critical role in this regard. As of June 2019, a total of nearly 1,200 U.S. credit unions, almost 25% of all credit unions, are headquartered in rural areas across the nation. Rural-based credit unions report $106 billion in total assets and approximately 10 million memberships, nearly 20% of the total population in rural areas. Despite population declines, rural credit union memberships are up by more than 15% since 2013, and they've grown by an average of 2.5% per year over the past 5 years. That's approximately 25 times faster than the rate of population growth in these areas. Rural credit unions delivered an estimated $1.2 billion in direct financial benefits to their members in the year ending June 2019. These benefits arise from the credit union not-for-profit structure, of course, and member ownership. Credit unions pass profits to members, not outside stockholders, in the form of lower loan interest rates compared to the banks, higher yields on savings accounts compared to the banks, and fewer and lower fees compared to banks. Rural credit union loans have increased by $26 billion since 2013, with annual average growth of nearly 8% over that period of time. Annual increases in rural credit union loans have consistently outpaced those in the for-profit sector in recent years. This graphic shows the credit union increases against those in total bank lending nationally. In percentage terms, new and used auto loans led the way, with annual growth rates in balances outstanding averaging 12.2% and 9.7% respectively since 2013. Combined new and used auto growth totaled over $12 billion in that period. Credit union commercial loans increased by an average of 7.2% since 2013, a $2.5 billion increase in the period. Rural credit unions stand ready to continue to serve. Collectively, they reflect strong financials with healthy earnings and solid capital positions, proving that it's possible to do well while doing good. Return on assets, or net income as a percentage of average assets, came in at an annualized 0.83% during the first half of 2019, and it's averaged 0.71% since 2013 at these credit unions that are headquartered in rural areas. Net worth as a percent of total assets finished mid-year 19 at 12.1%, up from 11.5% at the end of 2013. It's obvious that credit unions alone can't solve the problems faced by rural Americans. But the record is clear. Credit unions are engaged and committed to these communities, providing substantial capital infusions and significant financial benefits. Rural America increasingly recognizes and embraces credit unions and the credit union difference. Well, that's the current view from CUNA offices here in Madison, Wisconsin. If you need additional information on these or any topics, visit the website at www.cuna.org/economics or email us at custat@cuna.coop. Thanks for joining me, and thanks to the CUNA Finance Council for sponsoring this video update.